Welcome to this explainer. Today, we're jumping straight into the harsh realities of market timing and unpacking the true emotional cost of deploying your cash. We hear it all the time, right? People sitting on a pile of cash, watching the market climb higher and higher, and feeling that intense, almost painful itch to just throw it all in. But today, we're going to look past all that hype. We're going to break down the math, the psychology, and the heavy reality of what it actually means when you commit your money.
So let's dive into this burning question that's probably giving you some major fear of missing out right now. Can I invest a lump sum right now? You know the feeling. You've got cash sitting in a bank account, maybe it's earning a little bit of interest, but you see the stock market making these huge moves and you just start to wonder if you're being left in the dust. Honestly, it's the most common question investors ask whenever the market feels hot.
Well, the short answer is actually yes. You can absolutely invest that lump sum today, but and this is a massive caveat that changes everything. If you ignore this but, you could literally be setting yourself up for a financial and psychological disaster. Investing a lump sum isn't some magic trick to instantly boost your wealth, you know? It's simply a mechanical tool to adjust your portfolio.
The absolute key takeaway here is that you should only make this move if it's dictated by an objective, pre-existing asset allocation plan, like one you already wrote down. It cannot be influenced by whatever the morning news is yelling about, it can't be driven by FOMO, and it definitely shouldn't be a knee-jerk reaction to a recent market dip. If your decision is based on a gut feeling rather than a solid framework, you're already walking on really thin ice.
Okay, so this brings us to a really staggering anchor. 50%. I want you to really visualize this for a second. If you put all your cash into the market today and tomorrow you wake up to find it has dropped by 30 to 50%, what is your immediate physical reaction? Do you completely panic? Do you lose sleep over it? Because the true cost of a 50% loss isn't just numbers on a screen. It's deeply, deeply emotional. If you can't stomach that kind of drop without wanting to sell everything in a panic, your target stock allocation is simply too high.
And that brilliantly illustrates what we really mean when we talk about investing. Equity allocation isn't just a mathematical percentage on a spreadsheet. It is a deeply personal commitment that you make to yourself to persevere, even if your returns are thoroughly disappointing for several consecutive years. It's basically an emotional contract to endure the true cost of those painful temporary losses without abandoning your overall strategy.
Section 1. The reality check. Is a high equity allocation actually right for you? Let's find out. Before you pull the trigger, you absolutely must ask yourself these 4 foundational questions. First, how many years are actually left until you need this cash? Second, do you have a plan to dial back the risk as that target date gets closer? Third, are your emergency funds completely locked down and totally separate from this investment? And finally, tying right back to our 50% anchor, can you honestly maintain this strategy during a prolonged, agonizing downturn? Now, as we'll see, this sets up a massive paradox for investors. It's a classic damned if you do, damned if you don't situation. On one hand, you put it all in at once, the market plummets, and boom, you face an immediate, crushing loss. But look at the alternative. You spread it out over 12 months, the market shoots up, and you are just consumed by the regret of missing out. Either way, regret is highly, highly possible. Because there are no magic answers to just completely eliminate regret, you have to rely on a pre-existing plan based on your own self-awareness. If you're playing the long game and you can tolerate that crazy volatility, make a clear plan and deploy. If you're feeling nervous just thinking about it, break those funds into manual, batched installments to ease your way in. And if you're very uncertain, just pause. Stop completely. Your target allocation is probably way too aggressive for your true risk tolerance right now.
Now, what's really interesting here is a common myth a lot of people fall for. They think, hey, I'll just use a systemic transfer plan, an STP, to automatically drip my money into the market, and that's going to fix my anxiety, right? Sounds like the perfect little safety net.
But the reality is actually quite different. STPs do not magically erase your risk. They just spread your entry risk out over a certain period of time. Once that transfer period is over, all your money is in the market anyway. If the market crashes the day after your STP finishes, you are going to feel the exact same psychological pressure and face the exact same true cost of loss. You just cannot automate away the need for an honest risk assessment. Section 2. Rebuilding Confidence, the 5-point decision framework. So instead of relying on false safety nets, let's equip you with a rigorous 5-point roadmap. You've got to check off every single one of these criteria before making any one-time lump sum investment. Let's walk through them one by one.
Starting with point 1, your target time frame. If the money you're thinking about investing is needed in less than 7 years, whether it's for a house, tuition, or living expenses, you must exercise extreme caution. Markets can, and absolutely do, stay down for extended periods. If your timeline is short, bumping up your stock exposure is a really dangerous game.
For point 2, you've got to do the homework. You need to physically write down your current asset allocation and your target allocation. And more importantly, write down exactly why you are setting this target. If your reason is just, my buddy made a ton of money, or I saw this great post on social media saying stocks only go up, stop right there. Your allocation has to be built on your personal financial reality.
Moving to point 3, rebalancing your funding sources. Let's say you decide to increase your stocks by selling off some bonds. You have to stop and ask, were those specific bonds originally put there to protect your immediate, short-term needs? If they were your safety buffer, do not arbitrarily sell them just because stocks look shiny and attractive today.
Point 4 forces you to confront that brutal anchor we talked about earlier, maximum acceptable risk. Think about the true cost of a 50% loss again. If this new investment instantly takes a nosedive and drops by 30, 40, or even 50%, can you honestly remain calm? Will you stay the course, or are you going to panic sell at the absolute bottom? If you can't handle the heat, dial back the plan.
Finally, point 5. An allocation decision is completely unfinished without an exit strategy. If you're ramping up your stock investment today, you must have a concrete plan detailing exactly when and how you will reduce that risk as you approach your finish line. You need a glide path to protect those gains, right? Section 3. Putting it into practice. A practical example. Let's see this in action. This brilliantly contrasts two very different scenarios. On the left, we've got an investor with a super stable income, plenty of emergency cash, and a 15-year horizon. For them, dropping a lump sum to hit a 65% equity target, totally reasonable. But look at the right. We see an investor with an unstable income, less than 8 years to go, and low reserves. For them, jacking up their stocks just because the market is up isn't just risky, it's actively counterproductive to their actual survival.
Section 4. Wrapping up, avoiding the pitfalls.
Before we finish up, make sure you're avoiding these hidden traps. Do not treat every market downturn as a guaranteed, surefire win. Never deploy cash without that written plan we just went over. Stop thinking that phased investing is a magic shield against regret. And above all, absolutely do not blindly adopt an aggressive strategy that you haven't emotionally tested in a real-world bear market.
Ultimately, the secret to this whole decision isn't the lump sum itself. It's ensuring your underlying plan is totally sound so you can invest methodically without the panic. If you're sitting there lacking confidence, agonizing over timing the market, the problem is almost never the timing. The problem is that your chosen asset allocation vastly exceeds your emotional preparedness.
Which brings us to the end. I want to leave you with this final, provocative thought to chew on today. Considering everything we've just covered about the true cost of a 50% loss, the sleepless nights, the urge to panic sell, the real risk to your timeline, I want you to look closely at your portfolio right now and ask yourself, is your current asset allocation actually exceeding what you can emotionally handle?